Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock with news. Equity markets have finally realised that the COVID-19 virus threat will cause very major problems for investor returns. But first, the pace of home price growth in the American market sped up in December from earlier months, marking a full 8 years of price increases in American homes for sale. Average home prices in major metropolitan areas rose 3.8% in the year that ended in December, although that was down from the 4.5% growth in 2018. And the widely watched Conference Board Sentiment Survey edged up in February, suggesting American consumers are oblivious to the risks ahead and expecting the pace of consumer spending that could support their economy, even if Wall Street now doesn't believe it will. The Richmond Fed factory survey in the American mid-Atlantic states wasn't so positive, however, reporting a sharp fall in activity in February. And the latest compilation of the COVID-19 data shows that there is now 2,690 cases outside of China, and in places like Iran, that is probably way underreported. A week ago, that number was 1,463, so about doubled in 1 week. And in Hong Kong, the depressed economy is devastating their housing market. The expectations are now that large numbers of homeowners will be in negative equity situations. It's likely to be similar in many mainland Chinese cities also, although news about that is absent from China. And some investors see opportunity in a crisis. China's margin trading is picking up as investors rush into the stock market on expectation that the Chinese government will step up stimulus measures to support their economy. And Wall Street is adding to yesterday's sharp losses today, down another 2.4% in mid-afternoon trade. That has wiped out all of the 2020 gains. Overnight, European markets fell almost 2%, and yesterday Tokyo fell 3.3%, although some of that was a holiday catch-up. Shanghai fell 0.6% yesterday, but Hong Kong actually managed a small 0.3% bounce back. And the International Energy Agency reported that carbon dioxide emissions were unexpectedly flat in 2019, despite world economic growth of 2.9%. Increased emissions by developing countries were offset by reduced emissions by developed countries. Developing countries now emit double the carbon emissions that developed countries do. And the US Treasury 10-year yield is lower again, now just under 1.32%, and that's lower by another 4 basis points overnight. Actually, it's a record. It's a record all-time low, even lower than in the GFC. And gold has reversed course today, down $26 to $1,647 an ounce. And US oil prices are staying lower at just under $50.50 a barrel. The Brent benchmark is also lower at just under $55.50 a barrel. It's all driven by demand fears. And the Kiwi dollar will start today lower at 63.2 US cents, adding to last week's fall. On the cross rates, we're a little changed at 95.9 Australian cents, and against the euro, we're down to 58.2 euro cents. That means our trade-weighted index has dropped to 69.2. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.